Hey, welcome back to the channel. This is Joshua here with all things mortgage related. And in this series of videos, we're kind of going through the start to finish of getting a loan. Last week, we talked about the pre-approval versus pre-qualification process. And in this video, we're kind of going to go over the different documentations that the lender is going to ask you. So this might be a bit of a long video. I'm kind of going to move quick just to keep it short. But if you've got questions, be sure to put those down in the comment sections below or just reach out to me directly. Okay, so we're going to talk broad range. There are so many details in a mortgage and so many documentations that are possible, but most of them won't apply. So we're going to just keep it kind of simple here. But just know that this is not an all-inclusive list of things you might need. Essentially, what's going to happen is you've done the application. So once you've done that, the documentation needs to support the income you've listed on the application. We need to support the assets you listed on the application. We need to support the debts that you have. And then there's other miscellaneous categories. It just kind of depends, and we'll hit on some of the big highlights. Now, while I go over these two, I'm going to kind of explain a little bit about why we ask for what we ask for. So let's start with income. Now, income is going to vary a bit depending on the loan program you're going with, whether or not you need tax returns or not. So again, we'll do general. And so don't be surprised if the lender might ask for a little bit less or a little bit more. So in general, let's just say you'll need 2 years federal tax returns with all pages and all schedules. So don't just send over page one that kind of you think shows a summary. They're going to want to see Schedule A's. If you got a Schedule C or F, whatever it is, they're going to want to see them all. If you completed it, they want to see it. So 2 years tax returns. In addition to that, you'll need to provide your W-2s to support those 2 years tax returns. And if you're receiving things like pension, Social Security, disability incomes, then the lender will require your award letter for that year that stipulates how much you're receiving for that year. Those award letters are beneficial to you because typically the letter will actually show a higher amount, which the lender can use, than what the deposit into your account shows. So in addition to that, then, if you're a wage earner, so you're getting a paycheck, they're going to ask for a 1 month's worth of pay stubs. So if you're paid once a month, you only need to send one. If you're paid bi-monthly or semi-monthly, or bi-weekly or semi-monthly, then you'll need to send 2 pay stubs. And if you're paid weekly, 4 pay stubs. They're looking for this to show that the average hours worked in a month are supporting the full time, or if they're fluctuating or not so much. The other key thing they're looking at is, does your pay stub show that the employer is withholding things that might indicate debt or does indicate debt? For example, do you have your wages garnished for child support or spousal support or some type of other judgment? They're going to look for those types of things that are being withheld from them. And those are the most common things you see, but there are some other ones. So that's your income. And again, depending on if you're self-employed or not self-employed and how long you've been self-employed, you may need less or more. If you are self-employed and you file 2 tax returns, one for your business and one for your personal, you will need to send both business and personal returns. As long as you're more than 25% or 25% or more ownership in a business, you got to send those returns. Less than 25% in the business, don't have to send the business returns. Okay, so now let's move on to assets. Typically, assets are going to be documented with the most recent 2-month statements. Now, these need to be copies of actual statements. So, your lenders, if you send them screenshots or you send them transaction histories, they're going to come right back to you and say, sorry, this doesn't work. I need copies. So if you don't receive monthly statements or you throw them away, you'll have to log online, go to your e-statements, download your actual statements, and provide those. Now, why does a lender want 2 months asset statements? The reason for that is they're looking for, I would say 2 main things. One is they're looking for, are the assets being used yours? And so if you had, for example, 1 month, $10,000 in your account, and the next month you had $30,000, that's a pretty big jump. And so the lender's going to look at that and see where that large deposit came from. And then you're going to have to document to support that large deposit is your money according to the guidelines. So this can be done again if it's a tax returns. It might show the IRS deposit. Great, that self-explains itself. Maybe it was a bonus. So if you deposit a check, you might have to get a copy of the check to show it was a bonus. But the problem you get is when you start to have things you can't verify. So most common would be cash. So borrowers who don't really necessarily trust the banks or whatever, so they keep a lot of cash on hand, and all of a sudden they say, hey, I'm ready to buy a house, I'll put it all in the bank. That's going to cause an issue for you because there's no way to prove that money is yours. And the program requires to prove where the money is coming from. It has to be from an acceptable person. So your money is acceptable. If it's a gift and you can document the gift with gift letters, that's acceptable. But what's not acceptable is just money coming in that can't prove. The other common place you might see this that can sometimes cause a bit of an issue for the borrower is maybe you sold an asset, you sold a truck. Now, selling things like that's fine, but that will lead to additional documentation to show that you own the truck, what was the value of the truck, and who bought the truck. And again, they're just looking to make sure all the money's clean. So 2 months assets. Now, one thing I want to say about assets is, for the most part, once you have enough assets to meet the requirements of the program for your down payment and your closing cost, if you need reserves, whatever that might be, any assets in excess of that really don't help you. So if you have like 5 or 6 accounts, but 2 accounts will work, and that's where you're going to use the money from in those 2 accounts, just list those 2. Don't worry about the rest of them. It'll save you time from tracking down all those different things. Plus, everything you provide the underwriter, they're going to scrutinize, and they might come back with more questions. So there's a little tip for you. Only add enough assets that you need to actually complete the transaction. So let's go on to debt. So how does the lender go through and verify the debt on the application? Well, for the most part, debt will be verified with your credit report. We don't look at things like cell phone bills or which you spend at Starbucks or whatever the case might be, cable, garbage. We don't look at that. We're looking at consumer debt like car loans, credit cards, judgments, student loans, those types of debts where you have a mandatory obligation to pay that back. You can typically quit a cell phone company anytime you want, although I know a lot of us are in contracts with our companies. But that's the general rule. Now, in addition to that debt, you might need additional documentation if you're paying alimony or child support, or if you have an IRS back tax payment, then you'll need to provide additional documentation to support that debt as well. With child support, it's the signed divorce decree by the court. In the case of a divorce, it would be the signed divorce decree by the court. And then if you've had things like bankruptcies as well, there might be some bankruptcy documentation needed as well. So that's a general overview of debt. Now, moving on to the others we kind of covered in the debt. That's where most of these others come from. But other things would be like if you have lots of properties you own, then you'll have to provide documentation like mortgage statements to show whether or not taxes and insurance are being accounted for in that monthly payment that usually would show up on the credit report. But the credit report doesn't tell us whether or not that includes tax and insurance. So you might have to provide insurance binders for properties, mortgage statements for properties. If you have private loans that you've got that aren't reporting to the credit report, then you would have to those types of documentation as well. So there you have it. There's a very broad general overview. Just before I wrap this up too, I'll just say this is probably the number one thing that gets most people frustrated is the documentation that the lenders are going to ask for. Kind of feels sometimes a little bit intrusive. Even if you have great credit scores and you're putting a big down payment, the lender has got to follow the guidelines as written out. The guidelines are going to require these documentation. So be patient with them. Do know that what they ask for and the format that they ask for is what they need. So again, trying to substitute things that you think would work almost never do work. So if you've got questions on that, talk to your lender. They'll help you through this. If you haven't, again, any questions, feel free to reach out to me. If you're finding this kind of video helpful, be sure to hit subscribe so you can see the other videos as they come online. Also, be sure to share these with other people you know that might benefit from learning the process of buying a home. If you know how the process works, it's going to greatly reduce the stress, and that's a great thing. Until next time, have a great day.